Hello and welcome. I'm Real Crowd CEO Adam Hooper, and this is the Real Estate Investing for Your Future podcast. Here we explore the latest in commercial real estate trends, insights, and investment strategies that passive investors can use to build real estate portfolios that last.
All opinions expressed by Adam, Tyler, and podcast guests are solely their own opinions and do not reflect the opinion of Real Crowd. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. To gain a better understanding of the risks associated with commercial real estate investing, please consult your advisors.
Our guest today is Doug Ressler, Senior Research Officer at Yardi Matrix. Yardi Matrix offers one of the industry's most comprehensive market intelligence tools for investment professionals. Whether you're an equity investor, lender, or property manager, they provide data and management solutions for multifamily, student housing, industrial, office, and self-storage property types. In today's conversation, Doug breaks down which multifamily markets are growing, which ones are declining, and covers some of the key market factors multifamily investors should focus on in 2021. We hope you enjoy this conversation with Doug Ressler from Yardi Matrix. Well, Doug, thank you so much for coming on the show today. We're excited to hear everything that you guys have been up to at Yardi Matrix. It's been a while since we had Jeff on, so excited to hear what's new in your world.
Thanks for having me today, guys.
So before we jump in, why don't we take a little step backwards? Tell us how you got started into real estate, what attracted you to this asset class, and kind of what brought you into your role at Yardi Matrix.
Yeah, in 2008, I joined Pierce Island as an analyst, intelligence analyst, and basically at that time, Pierce Island dealt with residential properties, 50 units and above, and our subscriber base were loan originators, property managers, owners, developers, that type of thing. And so they had been at it since 2000. They had initiated the business because there was no value proposition for a lot of the data. A lot of the data that was acquired was scraping, web scraping, things like that. And what we did is we actually went out and contacted people directly as renters to get the real data as best we could for all the properties in, at that time, about 37 markets. In 2013, Yardi Matrix added us to their Yardi Systems added Yardi Matrix to their portfolio because Yardi Systems is a much broader envelope. They're a privately held company. They deal with asset management software worldwide. And they needed a piece that was residential, which we provided. And since that time, we've also added elements other than just residential to our portfolio. We've added student housing, self-storage. We're also into single-family rentals now from Yardi Matrix. And then there's the broader suite of Yardi Systems that has commercial edge, office, industrial. They also have in-depth asset management in terms of Yardi Voyager software to manage said properties, et cetera, et cetera.
I think that's what's been so fun to see is, right, I mean, Yardi was historically more known as kind of the asset management, property management suite of software, right? And then to be able to transition into this position where you can actually analyze and do something with all that data that's being collected through the system, right? In finding those insights, it's just fascinating. And I think we've seen that shift of people that historically haven't known what to do with this massive amount of data, and to be able to see how you guys have leveraged that and created new products and insights from that, I think has been really interesting to watch. So excited to kind of dig in on that today.
And just one thing to add, a lot of our data too, I mean, it's integrated in terms of the Yardi silos. The Yardi Matrix data is integrated. And Asset IQ, Elevate, those are two of the most popular ones. They have come on board in the last 2 years. And it goes to what you're saying, is that those are used as tools or technical types of instruments to be able to look at what's going on and analyze, to be proactive.
Yeah, well, so you've grown from, I think you said it was 37 markets that you were looking at originally, to now, I think the latest multifamily report was 130 plus different markets.
That is correct.
Tell us some of the trends. I mean, again, we've just come out of one of the more interesting times, for lack of a better word, more tumultuous times in this last 12, 14 months. What are you guys seeing in the data? How does that reflect on what we've just gone through, and how does it look kind of across the nation at a high level right now?
I think from a high level, what we're seeing is that the recent year and a half have really pushed the cycle in terms of time to be able to incent things that heretofore would have taken, say, multiple years to be able to accommodate. An example of that would be, the remote work from home. There's a big thought process that says, well, I need to have creativity and I need intellectual property, but doesn't necessarily have to be 100% of the time in terms of an office environment. Can it, be successful if you're working remotely? And I think that, there's many instances that people are looking at what they call the hybrid model. So we see that occurring. In addition, one of the things that has occurred during the health crisis is that certain policies have um, shut off the tap, if you will, in terms of immigration, in terms of migration. There's been a lot written about migration out of gateway cities, but what I think people forget is that the inflow, gateway cities are big practitioners of immigration in terms of people moving into large gateway cities. And because of policy and because of the health pandemic, the tap input has been shut off. And so what you see is a residual of outbound migration. And so we don't think that there are migration patterns. We see that. We believe, too, that in the rental market, along with everything else, it's more of a hedonic model where consumers are looking at the price they pay for housing and other items. And that really is one of the major drivers as to what dictates where and you live and in terms of your social environment.
Yeah, and so I think we've talked about that a little bit in a prior episode of, as you mentioned, right? These major metros, coastal cities have typically kind of refreshed that out migration with new immigration, new population coming into those cities from outside the country, right?
Yes,
And when that's
definitely.
cut off, you've got this. You don't have that new population coming in to replace, and that's what you said is driving this kind of decline. And we'll talk about that a little bit with what we've seen in the rental rate drops. But going back to overall rental rates, I think we've been tracking the NMHC rent performance, and it's held substantially better with historical than we would have expected, certainly through the early parts of the pandemic and even through the most of last year. What have you guys seen in terms of actual rental rates broadly across the country? Have those held pace? Have they gone down, up? What are you seeing there?
Again, it depends on the market, but what we have seen, because we measure rental rates in all the major markets, but we also measure it by the classification of the property. In other words, A's being the top end, C's being workforce, that type of thing, affordable. And so we slice and dice it a lot of different ways. So one of the things that we see, and I think people tend to want to just focus on the pandemic a lot, but prior to the pandemic, we had an affordability issue, which we still have associated with us. And it's basic economics of supply and demand as to what's driving the market in terms of now, like it has been in the past, that says, well, you know, are rents going up? Are they going down? Are they going up for certain segments? The biggest demand that we see, especially in the Southeast markets like Orlando, things like that, we see immigration is driving a lot of the market down there, especially the B's and C's workforce, not so much the top end. And so to be able to say what's going on, you also, I mean, when you look at the aggregate, the national numbers, yeah, you're starting to see a slight increase, but that's because of time period dependency, which is a big statistical term that says I measure year over year, and when the bad months fall off and the new years come on, it looks like it's increasing, from the math. And so what you have to be able to do is to look at that and look at how each market is being handled and dealt with differently. Certainly the Southwest markets, the Southeast markets look good in terms of overall rental rate increases. but a lot of the demand is in workforce, and that's not where a lot of the supply is coming in, being built. So you get into an economic disparity in terms of what people want, how much they want to pay, and where the demand is based off the supply.
And now this time dependency is an interesting one, in the sense that at any point throughout this year, when we look back a year ago, almost any number is going to look great, right, in terms of
Absolutely.
growth. And we saw that with inflation. We're seeing that certainly with some of these rental statistics. How much weight do you put in that? I mean, do you have to look at, I guess, the period that you're comparing it to and put kind of an asterisk on that, or is there
the way
I'll
tell you the way we look at it, we look at the demand drivers. We're a database driven type of, so you have to dig a little bit deeper. You have to really look at the demographics, like Hal Varian, he's a physicist by training, but he's marketing for Google. And he said, if you're going to be able to really explain something, you have to look at the demographics. You have to look at the demand drivers that are occurring. It's almost like rents, occupancy are almost symptomatic based off of what the real causation is occurring. So that's what we do. We break it apart by the type of properties. We call it context rating in our vernacular. We rate the properties, but we also rate the locations. We look at the amount of supply. We look at the migration patterns. We look at median income to be able to see if there's gentrification, non-gentrification. Does the median income support the type of market that's occurring in terms of the rentals that's being asked? What type of concessions are being offered, et cetera, et cetera.
And so demand drivers, typically we would think employment, population growth, job growth, those kinds of things. Are you looking at anything through a different lens in 2021 than you might have in 2019 or prior, given what we just went through, or have those fundamentals stayed?
Yes, we are
unchanged?
certainly. Yeah. Certainly, we're looking at lease rates. We're looking at right now. We've seen there's three distinct patterns in terms of spikes in rental rates. It's the January, Feb, the May, June, and then the September, October. Those are typically your heaviest frequency of rental activity. And one of the things that we want to look at is what they call the gap. The gap is, what is my existing rent? Okay, I'm getting ready. My existing lease is getting ready to expire. What's the new rate? So lease renewals, what's the difference in terms of price? Also, what's the duration? We've seen too, where some people are getting offered, this is again anecdotal, but they're actually, instead of a 12-month, they'll take a 15, 16, 17 type month just to retain the existing rate. So those are all things that we look at right now. And we see those are some of the biggest nuances that's occurring going forward.
And so we've seen some general recovery, I think, across most markets in the U.S. here.
Absolutely.
Are you seeing different patterns or different drivers from some of those coastal markets and gateway markets versus maybe some of the more interior markets in the country, more the kind of Midwest, Southwest stable markets?
What we see in terms of the gateway markets in terms of if you get the University of Pennsylvania and also Harvard have done some great studies along with some of the census. Our sister division, Rent Cafe, also has looked at migration patterns using internal Yardi proprietary data. And what we find is people don't move that far. If I were to look at the Bay Area, somebody may look for a better price, but they may look and say Oakland, across the Bay Bridge or whatever, because of certain other demographic, those kind of concerns. So the gateway markets, we think, are going to see, a recovery. It just is the duration based off of the work from home and what people do. Also, there's a lot of dry powder sitting on the sidelines in terms of investment potential. That plus, the policies, governmental policies that are, funding a lot of the surge. We see that as going forward is going to provide a great big momentum shift or a push, not only for gateways, but also for secondary and tertiary markets. Amazon fulfillment centers and distribution centers, you can read about it every day, all the way from Des Moines to, Atlanta, et cetera, et cetera. And that's pushing a lot of employment. It's also pushing a lot of income and economic health and well-being into secondary and tertiary markets that heretofore haven't existed.
Yeah, and I know in this the latest multifamily report, specifically, I think you said New York, San Jose, Los Angeles.
Hmm.
Those were some of the more impacted in terms of decline and certainly in occupancy rates. But it sounds like also there's going to be anticipated to see some recovery in those markets. What's driving that recovery back? Is it just a remigration back into the cities? Are we going to see more immigration coming in from external to kind of refill some of those pipelines? What are you
Yes,
seeing
yes,
driving
and
that recovery
yeah,
back?
yeah, but a lot of different. But the B1 visa program has been opened up again, or is going to be. So we see a lot of external migration that's occurring. Uh, when you look at the U.S. in terms of investment being less risky than other types of international markets, especially commercial real estate, that drives a lot of investment into that. We see people that are moving from a migration standpoint to where there's opportunities. If I can work from home, do I have to actually have to physically be in the location where my employer is? So we see it's a combination of all the things that you mentioned in terms of migration patterns and people wanting to move, but also at the same time being able to sit in place and have the economic well-being that heretofore they haven't in the last year or so. I mean, when you really look at it, the great financial uh, recession that we had, this isn't like that. This is really a more of a fact like there was a hurricane nationwide or worldwide. And so the recovery is going to be pretty dramatic and pretty fast.
And so these are, you would foresee maybe more temporary dislocations than a longer term trend. That's something we've tried to pick apart here on the show is what are some of these trends, as you mentioned before, this accelerant concept, right? Everything that we just went through was an accelerant of some of these prior trends that were already underway. And separating that from some of these longer term just systemic shifts of how these dynamics come together. Are you seeing anything in these migration patterns or in these, declines or increases in occupancy, depending on which market you're looking at? Is there anything that you guys have seen that seems like an interesting longer term shift that will remain after this recovery, or is it
Yes.
mostly going to be temporary reactions to what we just went through?
No, it's longer term, I think. If you, in some instances, what you look at is that obviously people are looking for, let's say, for example, and this is again anecdotal, but just to explain the point, if I wanted to, say, move to Orlando or something like that, I may look for a larger place. I may have 2 or 3 children, and I want to move and rent for a period of time until I look where to buy. And so what you see is that, and also maybe I even want to rent single family rentals. That's probably one of the hottest topics we see going right now. I usually look at the housing market as a Venn diagram. So you've got rentals, you got 50 units and up, you got 5 to 49, and then you got single family, and then you have ownership. And you have all those intermingling Venn diagrams that are occurring. And basically it's common elements. In other words, the peoples that use or provide the demand in all those Venn diagrams uh, could choose to rent, they could choose to rent a 549, they could choose to rent a single family rental. Um, and the sweet spot for renters is obviously in the 20 to 34 age group, the Z type renters, the Z demographic. Now you have, a lot of the millennials that are getting ready to buy homes. Well, can they buy homes? Again, you get back into the affordability issues. Are there homes to buy? And you have the inflationary spiral in terms of pricing and housing prices, so they may retain to rent. So right now, I think the demographic is such that the population of renters per se is really has a lot of different options. And I think that what you see is business or the markets being creative as to how to suffice to get around demand. Says, well, we have an affordability issue. We can't provide the supply. What do we do? I mean, you see everything from manufactured homes to single family rentals that people are doing and building to be able to create that.
Yeah, and I think that's one of those demographic shifts that again it'll be interesting to see how that plays in with, like you said, with the affordability. I mean, a lot of the DIY folks out there are putting projects on hold. We've actually seen a couple construction, development, ground up development projects that have been put on hold just because the cost of construction materials has gone up just so crazily that it makes a lot of those projects harder to pencil. So I don't know if that's going to help much on the affordability side, given where
Yeah,
we've seen
CNBC
just construction
did
costs.
I don't know if you watch them routinely, but 3D printing of houses or structures. I think it was Diana Olick she was being shown a 3D printing operation of a housing unit in the Bay Area, San Francisco Bay Area, and someone drove up, and I think this is so, it provides such a good example. The person drove up and they said, "Well, we'd like to buy this," and it was an apartment complex. They wanted to buy the apartment. They said, "Well, it's already been sold." And they said, "Well, can we buy the business then?" And I think what you're seeing is the viability of people are looking for alternatives. You're very well said in terms of the cost of materials is, astronomical in a lot of instances and is going through the roof. So again, how do you get the best fiducial return on the investment?
Yeah. And now switching a little bit to some of the local markets, and I know we're kind of jumping around here, but there was just so much information in the report. You mentioned in the report, Inland Empire, Sacramento, Phoenix. I think those were all over 8% in terms of rent growth. Those were markets that were already seeing some migration. They were seeing some trends prior to this pandemic. That would indicate, again, like you mentioned, the Bay Area, right? Someone getting out of San Francisco, maybe they're going to go up to Sacramento, more affordable. You get a better bang for your buck up that way. What's the story that's driving that rent growth in those markets? And again, is that more of a sustained trend, or do you think that will maybe have some reverses once the pandemic is sorted out and people are starting to go back into the cities?
Let's see if we can unpack some of that. I think when you really look at a lot of the markets like Phoenix, Las Vegas, Denver, Dallas, even, you get back to the equation of a finite variable is land. How's the land zoned? What are the restrictions? If I want to put up self-storage, if I want to put up an apartment, or if I want to do single family rentals, what's the cost associated? Is the land zoned appropriately, et cetera, et cetera? Now, in large gateway cities, you have a lot of restrictions. Obviously, in Newark and New York, things like that, you don't have the flexibility, especially in the zoning laws and codes that you do in, say, the Southwest. So that's part of it. The other thing is the economic diversities that's being brought to these areas. Certainly, big cities are not going to blow away. They are going to come back, and they're going to come back from a resilient standpoint. They do present, if you're looking at an investment from a demand standpoint, where are you going to look? Well, you're going to look where you have less risk. And obviously, big cities present a very good advantage in terms of economic diversity and a lot of incentive to be able to locate there from a pricing standpoint to be able to meet your needs. So cities are going to come back, and it's just a matter of how much time. Also, the recipient is going to be in terms of what we call the exurbs, those border areas that sit on the banks or the edges, the peripheries. You're going to see, there's those areas begin to expand too, especially in suburban office, that type of things. Mini cities where, it may look like there's a particular area in Atlanta out towards the new ballpark that just built. Eventually it's going to look pretty much like a little mini city as opposed to, well, that's really the suburbs. And people have this, view as to what's going to occur. But what they're trying to do is to embellish it with a lot of the city diversities in these mini hubs that sit on the exurbs or the borders surrounding major metropolitan areas.
And so do you see that as gathering what could have been some of that migration back into the more urban cores? Do you see more of those kind of hubs and spokes models, I guess, coming to the residential world? Yeah,
absolutely.
And certainly, again, I think accelerated by the ability to have more flexible work environments, right? Whether it's remote or part of the way going into the office. Yeah.
Yeah. Another thing that we also track too is in the communication networks. In other words, the networks, the Wi-Fi networks, do they have fiber? Do they not have fiber? That type of thing. Because, to be able to work from home with large data sets and things like that, you need some speed. Well, do you really have it? Obviously, That's another thing that has to be, we kind of overlay that to see. It's sort of like the internet or the electronic highway, if you will, along with transit-oriented development.
I can definitely attest to that with 3 kids zooming, streaming Zoom meetings all day for school. That definitely puts a strain on the bandwidth. That's for sure.
Absolutely.
So we talked a little bit about this time dependency of looking back and looking at things, comparative to a period before. But when you're looking at rental rates, what time intervals do you find are the most important? Right? Is it monthly? Is it quarterly? Annually? What period, especially since we're in such a volatile time right now, are you finding one of those time intervals being more insightful in terms of looking at rental rate growth or declines?
We track them all, but again, back to the point that I made before is we see those 3 points, January, February, May, June, and September, October is to be the major fluctuation points. We look at what we call our benchmark periods, to be able to give us a comparison set, if you will, as to what we're seeing on a month-to-month basis.
And so looking at those on a month-to-month basis, but then also, again, kind of quarterly, annually, should investors and listeners of the show here, should they be looking at those in any time period or another? You kind of need to look at all of them to try to identify some of those trends.
We would suggest they look at all because, again, each market and submarket is different. When people invest, they're not. They say, "Well, tell me about the Dallas market," but they're not really. The Dallas market at a aggregate doesn't really have that much meaning. You really want to take a look at, well, what is my investment strategy? Where am I looking? What is my competition in particular sub-geospatial areas, et cetera, and what is the rate? How big is the demand? In the energy corridor in Houston, if I were to say, well, I want to go develop down in the energy corridor in Houston, who am I competing against? What's the potential for the total demand to be able to fill the properties that I'm looking at?
Okay. And now let's take a little bit of a look at employment. The economy's been adding a bunch of jobs. Usually that's a pretty good indicator of what we can expect to see health certainly in the multifamily space. What is the employment market looking like right now in your eyes? And then how is it matching up with available supply or maybe pipeline supply of multifamily units down the road?
Well, it's probably dependent more on the market. When you really look at it, I think the numbers are about 8 million in terms of total unemployment. But when you actually add to it, you have to look at those people that are that have been furloughed, that aren't really working yet. Probably, I think Moody says the numbers are somewhere around 11 million. And so you look, well, how fast can I add jobs? I need to be adding somewhere around 600,000 to 700,000 jobs per month to get back where I'm going to be. So last month was a little bit of a down, 266,000 jobs were added as opposed to the month before. But we really see that the summer is going to present a little bit of a lag, but we really think that you're going to see all this money that's sitting on the sidelines or that the government is throwing at it is going to really start to spark business investments, so that we believe in the third quarter you'll see the improvement in those employment numbers.
And then relative to supply, given what we just talked about, I think a lot of projects kind of put the brakes on last year, and certainly now that we're seeing this pretty dramatic increase in just supply and construction costs, we've seen even more projects put the brakes on. What does that look like for supply going forward? And obviously, most of the supply was in the ultra high end Class A, right? That's all that could pencil before. So
50 units and up, you're right. Yeah, 50 units and up. It's always been that type, and I think that's going to probably maintain. I think we're going to see it is in these alternative type of housing, single family rentals and things like that. Again, it's still going to be measured on the cost of materials, the cost of my return. The other thing too is, how do you underwrite a loan? And I think we'll probably get into this a little bit later, but what kind of interest rate, what's inflation going to do? If you listen to the Fed, they're saying it's transitory. Don't worry about inflation so much, and they could be right. And then there's people on the other side of the coin that says, no. How do you underwrite a loan 3 and 4 years out?
Right.
In terms of interest expense and things like that.
And so that was one thing that we asked, before the show, what are a couple data points and key factors that you think investors should be keeping an eye on here in 2021? And
Obviously,
yeah, the
yeah.
inflation, interest rates, and capital flow. So let's unpack that a little bit. Let's maybe start with inflation. What are your thoughts there?
Well, I'm certainly not an economist of the ilk of Federal Reserve, and so the people are looking at, you can be on one side of the coin or the other. You think it's going to be transitory, that the Fed is going to maintain a low rate, that we're not going to see the pricing. And then you have the price increases, consumer price index. I'm not talking about, how much you pay at the restaurant and things like that, but durable goods, things like that. And if I think one of the keys is going to be if the supply chain continues to restrict and you have this unbridled demand, I think you're going to see inflation rates. In other words, if people can't get what they want and they have monies to be able to spend for it, I think that's one of the key concerns that the Fed has right now, in terms of saying, well, if we can keep that balance, if we can keep that supply chain where we don't see that getting out of that imbalance that's being created, you have a large demand and then you have supply chains that can't fulfill that demand. That's when you run the risk in terms of inflation.
And that's one of the benefits of multifamily, and real estate generally has been seen historically as a pretty good hedge against inflation. Multifamily more so because you're able to reset rents and kind of ride that up on a more frequent basis and longer term commercial, industrial office leases. So from our perspective, a lot of the conversations we've been having for those that are more anticipating an inflationary environment, multifamily seems pretty attractive to them right now. Which we'll see. And then that ties in also with the interest rates of, the end of last year, we were seeing just head scratching interest rates on certainly in the multifamily space. It seems like they've come up a little bit and have kind of continued to bounce around at what would be historically a very, very, very low level. Have you guys seen any indications or trends, or what are you looking at for interest rates?
Yeah, we have seen trends. I think what people are trying to do is spread the risk. You're seeing a lot more JVs, joint ventures, where people want to spread the risk in terms of a development. You see more repurpose. You see existing structures like schools or malls that are being repurposed into other uses. And so that's all occurring. And I think what you do is what you're trying to do is spread, if you already have sunk cost or costs that exist, can I minimize my risk by either getting a partner or taking an existing structure with a minimal amount of repurpose and fulfilling the needs of the demand. So we see those two trends that are occurring right now.
But we're not going to get you to go on record for any kind of interest rate forecast, are we?
No, I'm not.
No.
I'll let Janet Yellen handle that.
Okay. We tried. And then capital flow, I think, again, to what you just mentioned there, spreading out that risk amongst different property types. There's a ton of capital that is still flowing into the real estate space. And I think that's what we've seen, certainly in the multifamily sector, right? This pricing increase actually throughout the last year that I don't think we would have anticipated this time last year. Multifamily has certainly, a combination of very cheap debt, a lot of capital flow coming in, has certainly buoyed pricing and even pushed it in some markets. What are you guys seeing in the capital flow front coming into this asset class?
One of the things I think that the listeners should pay attention to is Pete Linneman from the University of Pennsylvania and a good friend of mine, Matt LaRiva from FCP. They've done a white paper, and what they're attempting to do is to measure the flow of capital. They think that the flow of capital, rather than the cost of capital, is probably more indicative of what cap rates are and what they're going to be going forward. And that's one of the things that we follow right now.
Yeah, we actually had Matt on the show a little while ago and got surface level on that concept, which is absolutely fascinating. Peter's been on the show as well. So we'll put links in the show notes to that episode. I would love to get him back on and do a deeper dive on that, because I think that the research that they're doing is absolutely fascinating in terms of how they're looking at a very different way of forecasting where pricing and cap rates are going. So we'll put a link in the show notes there as well. So beyond those three, what keeps you up at night right now, given we're recording this in second quarter in 2021? What's keeping you up at night?
Well, again, I think it's the housing affordability, inflation, and interest rates. Harvard's done a pretty good study. They've taken over 20 years worth of data, and they've looked at migration patterns, not only top end, but also people that said, well, I want to move from LA to Boise as an example, just as an example. And then they bifurcate it in terms of top end renters or housing and lower and the workforce, blue collar, that type of thing. And what they find is that migration pattern results in terms of many of these markets where you see the actual demand is increasing in areas or markets where it hadn't been so great. So you have this migration pattern that creates this large demand influx, and what you see is an escalation or inflation of pricing. And so that's one of the things that we have to look at very closely in terms of when people come to us and they say, well, what is the trend? What is your forecast? Those are all areas that we're looking at right now, and they can be very cyclical, but at the same time, they can be very unstructured because you have real-time markets or migration patterns that are affecting it.
And do you think 3D printing houses is the solution? Is that our fix to the housing affordability problem?
I don't think there's any one solution. I think that what you're seeing is the market, the water will seek its own level. So I think what you're seeing is single family rentals. Single family rentals right now, if you were trying to build it in an urban core, the cost of land would just be prohibitive. So what you see that is on the peripherals. Very good, very indicative. A lot of things that drives some of that, that where do people live? If you're a Z without children, things like that, you could choose to live somewhere else. But if you have children, you want to look at school systems. You want to look at where there's good school systems. And if I rent for a while, for a period, what schools do you go to? Well, when I buy the house eventually that I'm going to buy, do I want to move out of that school system? Probably not. So you're going to stay in that same general geospatial area, and those kind of things are going to drive. They're one-offs, but they're going to drive your choice of housing, and they're going to drive your choice of affordability.
Okay. What are you most optimistic about right now in the multifamily space?
I think just the housing market in general. I think that you're seeing a lot of, the pandemic or the longer term impacts going away in terms of various assets. You brought it up that, the commercial real estate is probably one of the least risk in terms of investment model. So we see that as being very positive overall, not just for residential, but we see it for things in terms of self-storage. They play off of each other. They're a collaboration. The industrial, the e-commerce, that whole thing, fulfillment centers, healthcare. One of the things that we see is people want to live near, their facilities for healthcare. Well, urgent care is now becoming very practical and very cost effective, as opposed to going to large hospitals and things like that. And hospitals see that, and they're actually investing in urgent care facilities. We think that's going to be one of the future trends going forward.
Okay. Well, maybe we'll have to have you back on to dig in on what's going on in the healthcare space, because that is definitely one that's we're seeing some innovations, some changes, whether it's in-home care or again, like you said, more kind of satellites with the urgent care clinics. A lot of interesting things going on in that space, which, similar to schools, can play into someone's housing choice, right? The availability of those resources.
Not only that, but you get the retail market that says, I've got this building and all of a sudden it's empty. Do I look for alternatives? How to fill it up? You bet. How about urgent care? And then you see an awful lot of leasebacks where people say, I'll go in and I'll lease it from you, and then I'll lease it back to be able to, because I'm going to use it, especially in the urgent care.
Yeah. Fascinating. Well, Doug, this has been a great conversation. Why don't you let us know and let the listeners know how they can learn more about what you're up to with Yardi Matrix?
Sure. If you can put the links in, obviously I've sent you some links too. We have a lot of things going forward. I mean, there's Yardi Systems, which is the overall branch. Yardi Systems has a tremendous amount of software and market innovations in the software, the technical Asset IQ, Elevate, Voyager. They also have special for property management. That Yardi has created software to be able to manage, terms of payment, things like that, in terms of arrears and special pandemic softwares, I would say, to be able to manage facilities and property managers at the convenience of the renter and the owner of properties, to be able to optimize and make sure that you keep, people whole. The other thing too is you got Commercial Edge. Commercial Edge uses a lot of our data. Their sister division, they deal with all the industrial, the office. You've got Rent Cafe. They're a B2C type of sister division that looks at renters and the kind of issues. So we collaborate on different kinds of things. Then you have the Yardi Matrix, which does a lot of the residential, self-storage, student housing, and single-family rentals. So it's a wide brush. And if you want to know more, I sent you the links. There's links, blogs that you can go to, or you can call me, and I'll send you to the right person.
Perfect. And we will have links to all those in the show notes. Again, ton of great information that comes out of Yardi. We've appreciated the relationship with you guys and appreciate you coming on the show. You've been so grateful with your time today, Doug. We appreciate it.
Thank you very much for the opportunity. I can't thank you enough.
All right, listeners, that's all we've got for today. As always, if you have any comments or feedback, please send us a note to podcast@realcrowd.com. And with that, we'll catch you on the next one.